When you went long on a call spread, your sentiment on the stock was bullish. However, if you're feeling bearish about that same stock, you could sell or short a call spread. To understand selling a call spread, let's imagine that when B collected the $100 premium from Arnold, she didn't actually own the record collection. Regardless, she entered an agreement where her friend has the right to buy those albums for $10 a piece when the contract expires in 5 years. Suddenly, she needs to find a way to protect her $100 profit. Fortunately, record store owner Jolene is ready to sell the collection to B for $15 an album in 5 years' time. To secure her right to buy at that price, B pays Jolene an $80 premium. Now B is in 2 option contracts. She shorted a contract to Arnold at one price and collected $100, then went long on another contract at a higher strike price farther out of the money and paid an $80 premium. At the end of that transaction, she collected a net premium of $20. Note the difference between buying and selling a call. As the buyer of a call spread, Arnold bought at a low strike price and sold at a high strike farther out of the money. As a result, his net premium ended up as a negative number. The net premium also represented his maximum loss. Where a call option spread buyer pays a net premium, a seller collects a net premium. As the seller of a call spread, B sold at a low strike price and bought at a higher strike price farther out of the money. Her net premium of $20 represents the maximum profit she can earn with her investment. As always, 2 scenarios can play out when expiration day arrives. The first is that the album collection B pretended to own is only worth $5 an album. There is no incentive for Arnold to pay $1,000 when he can get the entire collection elsewhere for just $500. Arnold takes the loss of the premium he paid and B keeps her $20 net profit. Since there's no need for B to provide her record collection in exchange for Arnold's $1,000, there's no need for her to exercise her right to buy the collection from Jolene. As a result, B realizes the maximum profit of $20 and the deal is done. In scenario number 2, on expiration day, the records are worth $20 each. Arnold is certain to exercise his right to buy B's records for $10 each. To make good, B exercises her right to buy Jolene's records for $15 each or $1,500 total. This brings her out-of-pocket expenses to $1,480. Record collection in hand, B goes to Arnold, who pays her $10 a record or $1,000 in total. Subtract that $1,000 from B's expenses of $1,480 to determine her final loss. We've previously mentioned that the risk-reward ratio reverses when buying and selling, but let's re-examine those numbers. When going long on a call spread, Arnold capped his loss at $20 and opened himself up to a potential profit of $480. When shorting a call spread, B capped her gains at $20 and opened herself up to a potential loss of $480. Now let's transition to the stock market. You're bearish on a stock trading at $50. Since you believe the stock won't rise substantially in the next 3 months, you short a call with a $55 strike price for 25 cents a share, or a $25 premium. To cover your investment, you go farther out of the money and go long on an option at the 60 strike price for 20 cents per share, or a $20 premium. Now you're in 2 contracts. In the first, you're the seller at $55 a share collecting $25. In the second, you're the buyer at $60 a share, paying $20 to secure your rights to buy. The premium you collected went down from $25 to $5, or 5 cents a share. To calculate your break-even point when selling a call spread, add the price you paid per share to the strike price you sold at. In this example, the break-even point is $55.05. When you short a call spread, you retain your profit as long as the stock price stays below your break-even. Every cent above the break-even is potential loss. If the stock's value remains below $55 until expiration day, there's no incentive for the buyer in your short contract to exercise their rights. Likewise, there's no reason for the seller in your long position to exercise their right to buy at $60 for stock worth less than $55. So, with no party interested in exercising, you walk away with your $5 profit and the deal is concluded. That's scenario 1. In scenario 2, the stock has risen above $60. In this case, you will realize your maximum loss. At expiration, the buyer comes calling and exercises their right to buy the stock worth more than $60 for $55. Fortunately, you covered yourself when you purchased that second call contract. As a result, you can exercise your right to buy the stock in your long position for $60 a share. So, you purchase the option shares for $6,000 and hand them over to the buyer of the original call you sold. According to the contract, the buyer pays you $5,500. This brings your overall loss down to $500. When you factor in the initial $5 you gained at the beginning of the contract, your overall loss equals $495, or a 9,900% loss. Once more, the maximum profit and maximum loss switch depending on whether you're buying or selling a call spread. Where the buyer experienced their maximum loss on the front end and awaited the potential return on their investment, the seller accepts their maximum profit at the beginning of the contract and hopes they don't experience their max loss at expiration. In our next video, we'll focus on buying a put.